Now, before you watch, if you could like, share, subscribe, that would be a huge help. Again, trying to get that support and drum up the additional movements, because you have to play the algorithm. So the more you guys do that, the easier it is for these to gain a bit more traction. And again, we always appreciate the help. So here, when we look at when we kick things off, we always like to look at the different averages. And here, when last week you had that increase above 15 million, we had a demand of 15.06. Now we're back to right around the average of about that 14.66 million, which is where, as we've been saying, where we think we live on that average piece of about 4.6, between 4.5, 14.5, 14.7 is kind of the quote unquote right number. If you consider the drop in trucking, the depressed amount of driving in terms of where gasoline normally is versus where it is now. And there's a lot of staying power behind some of that just on the trucking side due to a recession. In terms of just the movement of products, inventories normalizing, and then on the gasoline side, just more people working from home, less demand in general during the week, which is resulting in some of those declines. Now, when you look at the distillate stock build, distillate was at 1.12 build of 1.12 million. The average is still below 19.5, but again, the driver is pad one, so overall U.S. storage is 19.5 million below the 5-year average. Pad 1 is 19.4 million below the 5-year average. So when you think about where the issues are, I mean, there's one in one place only, it's pad 1. So how do you address that? And when you look at what was happening on the Colonial Pipeline, it was fully tapped out. Maximum amount was being sent up. Some of that maximum capacity, because when you look at increasing, line 1 is difficult just because there's a lot of different flows on that in terms of regular gasoline, premium gasoline, jet fuel. But line 2 has a little bit more variability to put additional distillates onto that pipe, and that started to show up. We did have an import come through, which was offloaded, so that's why imports dropped off in pad 1. And then we did have a Jones Act vessel come through. There is additional imports behind that, so we will see an increase again into pad 1. But we're still in a spot that is a bit difficult, just given where we are versus historics. But all of this is, again, promoting more production. Like the distillate front month crack is at $66. It's going to stay up there, as we've been saying. That 65 to 73 is a very comfortable level, just given the demand fundamentals and the backdrop behind where is our refining process and where is the demand center. So the lion's share of the U.S. refiners are in the Gulf of Mexico. The lion's share of current diesel demand is in pads 1A and B, which is again the the Northeast, as well as the tri-state area into the Mid-Atlantic. So you're going to have to see that crack spread, because you're going to have to incentivize additional movements of product, which is why the price of distillate and the price of diesel is so important when you're looking at underlying flows. And the arbitrage behind the Houston Ship Channel and the New York Harbor is going to remain elevated, just because you have to price in to incentivize some of these movements. And because shipping rates are so expensive, you're going to have to incentivize that premium in order to move additional cargoes into the Northeast. And this is just putting that into perspective. When you look at the disconnect between where we normally are, or have been over the last 29 years, and where we are today on the distillate front, you can see just how low we currently sit. When you look at pad 3, there's been 3 years higher, but we're above where we were in 2021. We're above where we normally are at this point in time. So it's really not a pad 3 situation or a or an all of U.S. component. It's a very specific location that is seeing those problems. And a lot of that is being driven by the loss of Russian flows. So that's why we talked about it in segment 1. Instead of Russia sending things into New England and into New York, they'll send it into the Middle East. The Middle East will commingle it and then they'll send it on its way, or they'll use that internally and then export all of their distillate into the Atlantic Basin. So there's a lot of things that are happening at this point in time. And then when you look at the demand drop is normal. That's what we've seen at this point in time. You've seen the drop already, and a lot of this is on trucking. The trucking demand coming down, but we will get some of that increase. The cold weather's remaining through the end of this year at a minimum. So when you look at all of these different pieces, it's going to continue through that route. So when you look at that trucking side, as we've been talking about, it's come right back down to where it's been. You can see that we're right at the levels that we saw in 2019, back below even the peak of 2018. So again, you're starting to see this slowdown. And the problem is the slowdown happening right now is actually when we normally have a pretty big increase. And that's a big problem in general when you're looking at where we are today and where we have been. This is peak time. So you have Target that's talked about slowdowns. You've now had FedEx talk about slowdowns. You've had Mastercard talk about slowdowns. So there is a big issue. And here's just using some FreightWaves data again, inbound ocean shipments. When you look at where things are internally, you can see those movements. In blue, the ocean container shipments from all origin ports globally on their departure date. In red, these same ocean container shipments as they land in the U.S. Already back to pre-pandemic level volumes on the water, headed this way when you look at the flows. Truckload spot rates have dropped to a new cycle low, down to $1.61 from $1.86. As we were saying, we saw that movement coming down, and there's still that breakdown between spot and contract. With spot rates coming down, contracts as they roll off are going to mark to market lower and put more pressure in terms of where the market is. But all of this is, again, leading to a bit more support on the rail traffic side. Rail traffic is fairly supported, just given if you don't need it right away, well, it's going to be cheaper to put it on rail than to put it on a truck. So that's, again, going to be supportive of where things are. Grains will stay stronger just because of planting, just because of movements of volume as the Mississippi remains below normal. That'll keep things moving onto rail as well. Then when you look at underlying flows, again, reiterating what we saw, now the port of LA is the lowest it's been in years, as I retweeted and people have been talking about, and it continues to go down. That is where we continue to see these problems in general, and that's where the issues continue to rise. And as you can see versus previous year, they continue to come down. And then when you look at some of the demand in general, that East Coast and a lot of these areas continue to see below normal weather. And that's going to continue as we go into the end of November and into December. And that's going to, again, drum up more distillate demand because heating oil demand is going to increase. So this is inherently supportive a bit on natural gas and, more importantly, on the heating oil side. When you look at what is hitting pad 1, because this is going through essentially November 25th, and you can see from now November 16th, which we know we're currently in a cold cycle below normal, and that's going to remain for the next 10 plus days, with more of that coming down the road. Then when you look at gasoline had a build of 2.21 million. We did get a drop in imports. Again, the issue remains the cost of shipping continues to remain elevated, which is hurting the import side. Here you can see gasoline had a build of 2.21 million. Sizable builds in pad 3 and pad 5. When you look at it on a seasonal basis, fairly normal to start to see the builds happen at this point in time. So really nothing crazy when you're looking at builds and the pace of builds. Imports is going to be the delta of how quickly do we see the builds come. It'll be on how much of those imports. Here you can see pad 1 had an increase of 148,000 barrels. That was going to drop back off a bit, which is going to be an important one to watch, just because how has the ARB open, and the ARB is open for short periods of time, then it closes, just because it's more profitable to move diesel. And because miles per ton are going up, driven by the additional capacity coming from Russia to the Middle East, attracting additional shipments, But then when you look at blending components only had a build of 680,000. So again, you'll start to see that normalize. But if you remember last week, blending components had a smaller draw than stocks. And that's why I said there was going to be a bit of a makeup in terms of some of those numbers, just because there is a certain amount of predictability. And then blending components also moves into the system because we're going to have some of those draws come in this week because guys are going to prepare for all of the demand for Thanksgiving week, which is next week. Blending components, you can see here, moving back up. We expect this to continue to trend higher, and the comps get easier, and then we expect it to pivot and actually follow fairly closely to where we were in 2021. Demand here, you can see the demand started to pick up. That is normal for this time of year when you're looking at North America. But it's, again, going to stay at this average. Like you can see, it drops, comes right back. Asia rolled over a bit. Europe is fairly stable. And then when you look at TomTom congestion for China, you're starting to see some of this come back. But again, it's very volatile, and a lot of this is being driven based on the lockdown. So there's a lot of commentary back and forth. We're going to talk more about it in segment 5 of the Econ Show tomorrow, but that's going to be an interesting one to watch. But again, we will get congestion indexes again picking back up, especially when we start looking at some of the different pieces, especially on North America. Then when you look at demand, pricing, gasoline prices have rolled over a touch. They're currently at $3.74. But when you look at diesel, we're right at $5.35. And again, you're still seeing a lot of these pressures to the upside, and we still see some additional movements to about $5.40, just given the disconnect and the issues that remain between the wholesale market and the retail market that has to move things through the system. Demand for gasoline, here you can see it's right back to 2021 levels. We expect it to, again, bounce up just because of Thanksgiving and then fall right back down and come closer to where we have been averaging at about 8.6 million barrels a day. When you look at underlying volumes, again, workplace is still 20% below normal, which is the biggest driver behind some of the issues that we've talked about. You're starting to see retail and recreation roll over a bit, and again, a lot of these things are going to be impacting the way people are spending because of retail sales, which we're going to talk more about next week, and what does that look like as we go into the holiday season. Propane, propylene, small build of 70,000 barrels, 4.9 million above the 5-year. But when you look, there's things have flatlined where typically we're starting to roll over. And the reason why is we've had an increase in supply and petchem demand has come down. And that's where you're starting to see some of these bills remain. Exports remain strong. They're going to stay strong. As Saudi Arabia cuts production further, that's going to reduce the amount of NGLs they have available to export, which will, again, be supportive of our exports continuing, which is a net positive, in terms of trying to keep us fairly flat, but it's going to put pressure on pricing. Jet had a build of 300,000 barrels. It's, again, fairly normal. When you look at demand cycles, we're right at where we were in 2021. Again, that 1.45, 1.55 is right there. A lot of this pre-movement is because you're making sure that you get product to the airports ahead of schedule. This week, you start to see an increase as people take the whole next week off. So they start flying over the weekend, making sure that there's product available. And that will remain fairly elevated. And then when you look at passengers, here you can see the normal spike. That spike is Thanksgiving. You can see it happened in 2021. It happened in 2019. It even happened in 2020. So we're going to get that seasonal spike and then fall back just below the top lines that we've seen in general. Then when you look at flow at departures going forward, passenger flight schedules ahead, 12 weeks ahead is 1.38% lower than it was last week. So again, you're starting to see that fall back down. Number of passenger flights over the week of November 8th to 14th dropped 3% week on week. So we will get a little bit of a pop, but you can get an idea that it's still below normal. It's rising along seasonal levels, but still below normal levels, which again is why we're still confident about our range of underlying demand. And then open table data still seeing fairly stable movements. Some of that is the prices still continue to rise for eating out and we do expect this to roll back a bit, but again, still remaining fairly stable given the data that we see here. So that's what we have for you on the U.S. in the next segment. And to be clear, when we look at what is happening, distillate prices are going to remain elevated. We still think that there's an opportunity. Buying diesel, shorting gasoline is still a very good ARB at this point in time, given some of the metrics. And when you look at just underlying productivity, gasoline production has increased slightly, where distillate production decreased slightly. But again, it's just a matter of what kind of crude do you have, what kind of availability, and the target's going to remain distillate, which is why we expect refinery run rates to remain well above normal, just because they're going to try to capitalize on that. So that's what we have for you on that segment. Next segment, we're going to talk more about OPEC and international flows and how the U.S. interacts with that in general.